For a long time, if you asked me what I thought about Nvidia options, I would have told you that I thought they were expensive. But today, I'm going to show you an analysis that actually indicates to me that buying Nvidia options and gamma scalping them could be a very interesting trade. What we're going to look at today is the level of implied volatility for Nvidia options relative to where they've been in the past. And we're going to compare that against the realized volatility that we've been seeing over the last couple of weeks to basically say, are option prices as they currently stand cheap or expensive relative to how much Nvidia is currently moving? So let's jump into the analysis and break this down. So the first thing that I wanted to point out is that Nvidia is still one of the most trending stocks here on Yahoo Finance, right? It's number 5 on the list, just after things like Netflix, which just had earnings, J&J, which just had earnings as well. So it's good to see that there's still a lot of attention on this ticker, right? It does lead this semiconductor space. As AI gets talked about more, we expect Nvidia to move, right? And to continue to see either gains or losses depending on the sentiment around the industry. So hopping over here and coming into Nvidia, what we're going to take a look at is, in particular, a few things. The first here is the volatility time series. So what I want to be comparing is the 10-day non-event realized and implied volatility. So basically, forgetting about earnings events, which there hasn't been any, what is the relationship between short-term vol, realized and implied, actually look like? So you can see that they sort of do this dance where they try to match each other. That's kind of how implied and realized volatility works. But since basically the start of the year, right, we've seen realized volatility outpace the implied volatility. Meaning if you had bought vol at, let's say, 40, right? So you bought it at the money straddle and then you delta hedged it or gamma scalped it, you would have made money because this thing realized about 50 vol or even higher, right? It's realized almost 55 vol at its peak here over a 10-day window. And that basically indicates to me like, hey, buying options has been good here for the last couple weeks. And as we continue this analysis, you'll get an idea of why I think it could be good to continue to have this position on. So another thing to note is that today Nvidia has moved about 4%, which is, a huge move relative to this as well. That's exactly what we want to be seeing. And vol has really only ticked up 1 point for 10 days options with this 4% move. So even though it's moving a bunch today, basically the market's saying we don't expect that to continue. So that's the relationship between implied and realized volatility in the short term for Nvidia. But what we also want to look at is, where are these options being priced relative to where they've been over the last year? We know that Nvidia has been extremely popular. It's been on a huge rally and vol has gone to very high levels. Is it still there, or have things calmed down enough now where maybe not only is implied volatility being outpaced by realized, but implied volatility is at a level where we could see some inflation in implied volatility, or it's actually not so unrealistic for it to continually sustain this higher realized volatility level? Let's take a look at the screening app. So when I come over to the term structure page here, what I'm going to take a look at is this volatility cone. So this is a really cool tool. It basically shows me a statistical analysis of all the different expirations for Nvidia, comparing where the implied volatility is currently relative to where it's been in the past. And what we can see here is that, right, if we just plot the current line, this is the current term structure, right? It's the same as this line here. These are the same. And if we plot that relative to where it's been on average, we can see that we're well below the average here. And two lines that I like to put is these Q1 and Q3 lines. And we can see for the short-dated options, we're below the 25th percentile here, meaning at least 75% of the time, probably pushing 80% or 90% of the time, implied volatility has been higher than this level historically over the last year. Putting the minimum line on, like the lowest we've seen it over this time period, right? If we look at like 20-day options, we're currently at 39. It's been as low as 32. So there's room for it to come down if things are calming down. But seeing a 4% move today with a slight uptick in implied vol on the 30-day, or it's 30-day vol here, indicates to me that that may not be the case. It's less of a concern for me. So with all that being said, we're looking at the level of vol here and we're saying to ourselves, vol is not at a very high level. So with all that being said, what we're really getting at is the fact that vol does not appear to be at a very high level. And not only that, but realized volatility, the amount the stock is actually moving, seems to be outpacing that implied volatility. So what we can do here is we can go in and structure a trade such as an at-the-money straddle, where we don't actually have a view on the direction, but what we've done is we've purchased this level of implied volatility. And what we can do from there is we can do something called gamma scalping, where we trade shares to maintain delta neutrality. And as time passes, if realized volatility continues to outpace implied volatility, the position will be profitable. If implied volatility ends up being higher than the realized, we're going to obviously lose money on the trade. But by doing the gamma scalping, this delta hedging maneuver, we are basically isolating the difference between the implied and realized volatility. And that's the trade structure that we're actually talking about here. So let's take a look at what this trade structure might actually look like for us. So here I am on the option chain for Nvidia. And what I'm looking at here is the 16 days to expiration options. I want to be doing something in and around the 20-day mark, I think. And when we look at this, we can buy a 146 straddle for about, so basically $1,000, right? $950 here. So at first you might be thinking to yourself, $950, that's a lot of risk for this one long vol trade. And something important to remember is that the cost of the straddle, if the thing doesn't move at all, it will go to zero. But the gamma scalping that you're doing, every time you gamma scalp it, you're going to be locking in a small profit. And so that's why, like this thing is not going to realize zero volatility. So your risk on this trade is not actually this whole amount. In reality, we'll say, it's maybe a few $100s on this. And obviously on the upside, it's probably a few $100s as well if we realize greater vol, right? You probably make 20% up or 20% down. It's probably about that much risk over the next 2 weeks on this trade. Now, keep in mind that you'll also need the ability to actually gamma scalp this. So you'll need to be able to trade shares around this as well. So keep that in mind. You need to have the margin availability to trade, let's say, about 50 shares at least at the same time that you're holding this long straddle. The good news is with a long straddle, it doesn't eat up any of your margin, just the $1,000 that you pay. And what I would be doing here is I'd probably be holding this close to expiration and maybe closing it out with a couple days left. And the reason is, you're trying to gamma scalp this. We're not trying to predict what's going to happen in the next one day. We're arguing that this thing should continue to move more than implied. And by structuring our trade this way, we should make, or we have a chance to make some money, right? In the end of the day, we are still long vol. There should be a risk premium, but we should make some money doing this if we continue to see the same level of volatility that we have in the last couple weeks. And I guess I'll end off on that note there, saying that in the end of the day, there should still be a risk premium here, meaning on average, we should still lose a bit of money. We're long volatility here. But in the situations where this continues to realize this high level of vol, there's a couple benefits here. Number one is this acts as a great hedge to a typically short volatility portfolio. If you're following this channel, it probably means that you are a net option seller. And so finding areas where options are cheap and adding that to your portfolio, or at least appear to be cheap, adds some diversification that is not correlated to your other strategies. So on average, we probably still lose a bit of money on a trade like this, but even if we can get a break-even couple-week long vol hedge, why wouldn't you have that in your portfolio, right? That's a great thing to have. So with that being said, if you're new to this channel, do subscribe, leave a like, leave a comment, bless us with the algo, help us out. And obviously, if you're an option seller, you should be signing up for a free trial with Predicting Alpha. We're an awesome community. Our strategies are not super exciting, but we run good strats. We give you the tools and the education for it. And there's some awesome people there. So yeah, check it out if you're new. And if not, then we'll see you in the next video. Take care, everyone. Peace.